Hey investors, Rockstar here, and listen up, today we're diving into the wild world of bonds, those so-called safe haven investments? Well, buckle up because we're about to uncover the truth. Bonds come with their own set of risks, and you need to be prepared. While bonds are often seen as safer than stocks, they do carry risks. Let's break down the main types of bond risks in detail. We're talking interest rate risk, credit risk, inflation risk, and a whole lot more. We're going to break down each of these risks so you can make informed decisions with your hard-earned money. Don't touch that dial because things are about to get informative. Let's do this. Alright folks, first up is interest rate risk. This one's a real market mover, so listen closely. When interest rates rise, the value of existing bonds falls. It's like a seesaw. Rates up, prices down. Let's say you've got a 10-year bond paying a measly 4% interest. Now imagine market interest rates jump to a juicy 6%. Suddenly your bond looks about as appealing as day-old coffee. Why would anyone buy your bond at 4% when they can get a brand spanking new one paying 6%? See, your bond's price has to drop to attract buyers, and that, my friends, is interest rate risk in action. Next up, we've got credit risk, also known as default risk. This one's pretty straightforward. It's the risk that the issuer of the bond, whether it's a company or a government, just can't pay back what they owe. Think of it like lending money to your unreliable buddy. Sure, he promises to pay you back, but there's always that nagging feeling he might not. If a company goes belly up or a government defaults, you could be left holding the bag, losing a big chunk of your investment. Always check those credit ratings, folks. Inflation risk is a sneaky one, folks. It slowly eats away at the value of your money over time. Imagine this, you've got a bond paying a fixed 3% interest. Sounds okay, right? But hold on. What if inflation decides to rear its ugly head and surges to 5%? Suddenly your measly 3% return is actually a loss in real terms. Your purchasing power is shrinking faster than a cheap suit in a rainstorm. That's inflation risk, my friends, and it's a real wealth killer. Now let's talk about liquidity risk. This one's all about how easily you can sell your bond without taking a bath on the price. Think of it like selling your car, a popular model in good condition, easy peasy, but a beat-up clunker with no AC, you'll be lucky to get scrap metal prices. Some bonds, especially those issued by smaller companies or municipalities, can be illiquid. That means finding a buyer quickly might be tough, and you might have to sell at a discount to attract someone, anyone. Ouch! Reinvestment risk is like that sinking feeling when your favorite high-yield savings account gets slashed to a measly 0.01%. You see, when your bond matures or when those lovely interest payments roll in, you've got to reinvest that money. But what happens when interest rates have tanked? You're stuck reinvesting at lower rates, which means lower returns for you. It's like trading your Ferrari for a used scooter, not exactly an upgrade. Call risk is a bit of a curveball thrown by bond issuers. You see, some bonds have a call provision, which gives the issuer the right to redeem the bond before it matures. Sounds innocent, right? Wrong. They usually do this when interest rates fall. Why? Because they can issue new bonds at a lower rate and save themselves some money. But where does that leave you? Stuck reinvesting your money at those lower rates. It's like getting dumped for a younger, cheaper date. Now if you're feeling adventurous and dabbling in international bonds, listen up. Currency risk can make or break your returns. When you buy a bond issued in a foreign currency, you're essentially placing a bet on that currency's performance against your own. If that currency tanks, your returns take a nosedive too. It's like going on a European shopping spree only to find out the euro crashed, and now your souvenirs cost twice as much. Last but not least, we've got event risk. This one's a bit of a wild card because it covers any unexpected event that can impact a bond issuer's ability to pay you back. Think lawsuits, regulatory changes, mergers, acquisitions, the works. It's like that moment in a horror movie when the lights flicker and you just know something bad is about to happen. Event risk is especially important to consider with corporate bonds, as companies are always susceptible to unforeseen circumstances. There you have it, folks. The 8 major risks of bond investing. It might seem overwhelming, but don't let these risks scare you away from bonds altogether. Remember, knowledge is power. To manage these risks, diversify across issuers, sectors, and maturities. Consider strategies like laddering, and look into bond funds or ETFs for built-in diversification. For inflation protection, consider TIPS or inflation-linked bonds. And there you have it. Now go forth and conquer the bond market, my friends. Keep those interest payments rolling in, and I'll see you next time. Booyah!